the end, climate action will depend on the economics that have to be right. We'll have to factor in the risks and volatility to which companies are exposed, and for sure, more than ever, regulation will play a key role to drive that action.
Well, welcome back to Decarb Connect's podcast. And this week we have a returning guest, Ben Moens from Engie Impact, where he's a managing director, is joining us for a bit of a, I guess we'll call this a pause in a way. It's a pause to look at where we are in this massive climate decade. So an opportunity to look back at what has happened, perhaps some of the things that have driven progress, some of the things that have impeded progress, some of the things that were unexpected, and then a look ahead as well. So before we get going, I just want to let listeners know that this episode is sponsored by our production partner, Jano Media. We've worked with them, well, basically since 2020, since Decarb Connect started, and their support is what really has allowed us to connect to our listeners over the years through hundreds of insightful conversations just like this one. So with that little thank you to Jano and that bit of admin out of the way, Ben, welcome back.
Hi, Alex. Thank you for having me back.
So here we are. I think probably the one thing that anyone involved in decarbonisation, energy transition, climate work would say is where we are now is, for better and for worse, not where we thought we'd be, perhaps back in early 2020. But why don't you kick us off? What's your kind of general reflection, and how do you want to break down this conversation that's looking at the sort of where we've come from and where we're heading theme?
No, yeah, sure. No, indeed. I mean, I've been also around for these past 5 years working on climate action, and it has been very interesting to see how basically the overall context of decarbonization, industrial decarbonization, has shifted over these past years. And remember, even when I started at Engie Impact, but it was at the beginning of 2020. We're in the middle of the climate marches, and we had a couple of very visible extreme weather events, and there was also the time of the UN report that mentioned the extinction of 1 million species. So it was really an area where we had a very strong sense of urgency, and not just a strong sense of urgency among our consumers, but also we individually, as employees and leaders in a company. Very much had a determination to make a change and take action. And we've seen that inspired a lot of companies to take voluntary action and to set public targets and announcements and have science-based targets, science-validated targets. Where we saw a tremendous increase in the number of companies that actually validate these targets. And I think today we're probably at 6,500 companies, and even 3,000 more companies that are committed to set targets. So that has been phenomenal to see. Same thing on RE100, and we had a threefold increase to more than 400 companies today. And so that gave us, inspired us and gave us a lot of sense that something was possible, and that we would really take this decade to make fundamental change and do the right thing, basically. But then I think as the decade started to unfold, I think there were a couple of major events that kind of shifted that perspective. And I think for sure it's one of the elements that started was the pandemic. Where I think for a lot of companies, it increased again the awareness and the importance of risk and resilience, in corporate decision making, and as a kind of secondary impact it had on, indirectly on climate action. It also led, of course, to a lot of cost inflation in materials due to these disrupted supply chains and also partly the recovery stimulus that followed it. So I think the pandemic, in a way, was not helpful because companies were starting to get more and more focused on risk and resilience. And then, of course, in Europe, where I'll focus most of my talk today, we then had the energy crisis triggered by the Russia-Ukraine conflict, and that for sure, shifted the attention away from decarbonization more to energy affordability and security of supply. So I think that was even compounded on the impact of the pandemic, very outspoken effect. And then I think a third key element that changed in these past years, it's a bit more technical, is the ETS, and so the emission trading scheme in Europe. and also the announcement of the Carbon Border Adjustment Mechanism. If you look at these two elements, first of all, the ETS price, beginning of the decade, we were still at at 25 euros, I think, in 2020, around 25, but then really spiraled and peaked towards 100 in 2023. And that, I think, in a sense, in combination with then the fact that we had the announcement of the gradual phase out of the free allocations starting 2026, really opened the eye for a lot of industrial companies, and put even more emphasis on the affordability of energy in Europe and energy related activities. So all of these elements, to me, was strongly felt, among my customers, led to the fact that the focus is really what I would say back to basics. In the end, climate action will depend on the economics that have to be right. We'll have to factor in the risks and volatility to which companies are exposed, and for sure, more than ever, regulation will play a key role to drive that action. And so, yeah, that I think is a very important evolution. And you already see a bit of a symptom on that, because if you look at these voluntary commitments that I mentioned, today, and it's obviously not very publicized, but what you see is that already close to 600 companies actually removed their SBTI commitments. So it's a pretty big number. And I won't name companies here, but just to put it a little bit in the right light, some of these are actually investing massively in the energy transition. We have companies there like ArcelorMittal and Amazon, LG Chem, etc. So it's not necessarily companies that are not taking action, but it's just to show that the voluntary aspects and also the science-based trajectory of 1.5. It's clearly not something that is fully aligned with where companies see themselves going or where they see their room to maneuver.
If I can jump in on that, because I think one of the other thing we have heard from some industrials is also they shadow SBTI, and they want to they take the approach that SBTI works on with those that subscribe to that system. But what they, again, I guess maybe because of this are we committing to 1.5? Are we committing to 2 or whatever? But they want the freedom to shadow that and take what's best from it, but also coming back to your previous point about relying on the economics also.
No, totally. And I think there have been surveys to understand what's the reason behind companies, either removing their commitment or hesitating to commit. And I think the two key reasons were, first of all, that they believe that the Scope 3 target under SBTI is too ambitious, in the sense that these companies feel they cannot control enough what's happening in their supply chains to be able to commit on that. I think the second key reason is just the uncertainty on technology development, and I will discuss some of that in today's podcast, and that for me is linked to indeed the risk aspect and affordability aspect, is that we've all become much more aware of how much these economics are not yet within reach, and how hard it is to take any commitment on that. And companies have become much more hesitant on that front. So, that leap of faith that we had at the start of that decade, that I think really has now been overtaken by a more sense of realism. No.
So let me ask you for a bit of a personal lens before we go into the kind of digging into some of the key areas a bit more. When you think about that the leap of faith and the kind of positive energy and this kind of the social push that Europe had, which wasn't the same in other regions, it was a particular kind of wider European drive. How do you see it now?
Globally, I'm positive, because I think on a lot of fronts, we've now reached certain constraints, indeed, about economics, about available technologies, etc. So I think generally there's a much better understanding of what it will take to realize the transition. So I think that indeed the positivism that we had at the beginning of the decade, much of that was not rooted into very firm commitments or economic considerations, and hence we're not backed up by true corporate decisions. So I think it's normal, that we go from a strong case for change to a difficult transformation path, and I think we're just in the middle of that. And at the same time, I see a lot of positive elements from these past years.
Okay, well, let's dive on in then to these. I think there's sort of 5 technology brackets. So we'll start then with renewables and electrification. I mean, definitely in 2020, this was the main lever anyone was talking about, I would say, at that point. So what's happened? What do you see? What's coming our way?
No. Yeah, like you mentioned, I mean, the renewables started obviously the previous decade already, and I think is an absolute success story. We've seen a continued decline in levelized cost of electricity, both for solar and wind. And Actually, in 2023 is the first year where in Europe we produced most electricity from renewables compared to fossil fuels and nuclear. So that sense, absolute success story. But actually, fairly recently in 2023, what we saw is for the first time we saw an increase of levelized cost of electricity for wind, both onshore, offshore, and that's of course partly due to what I mentioned and the cost inflation in terms of materials. Of course, we also had higher financing costs, and these two were basically not sufficiently compensated by by larger wind turbines. That was typically the play in the past in wind. The LCOE went down because turbine capacity was increasing. And that's where now we're getting a little bit into constraints, because when you look at the major wind turbine manufacturers, that race for bigger turbines, for the moment has paused a bit. So I think we're now stuck with 15 megawatts offshore, which are of course huge capacities. But it's not very likely that we'll make that leap to, for instance, 18 very soon. So we're there really starting to hit some barriers. Yeah, I think there was a very visible event, I think in the UK, the CFD allocation round, number 5 in 2023, where basically didn't receive any bid for offshore wind. And that was, I think, the wake-up call for the sector to see that indeed in terms of economics, something fundamentally changed. And if you know, that's the bid price in 2022, sorry, was still 37. Nobody signed up in 2023, and then in 2024 it was already 55. So there, for the first time, you see really that reversal in that cost trend. Now we shouldn't be too alarmed, because still, in terms of levelized cost of electricity, renewables still lower than the running costs of CCGTs, coal and lignite plants across Europe, especially when you take into account the ETS price. So renewables are absolutely still the right thing to do. Yeah. However, I think what has been, I think, for industrial off-takers, a big evolution in these past years is that you've seen PPA prices go up much more than this LCOE. So in 2022, I think they went up with almost 60%, declined a little bit since then, but you see indeed that cost inflation played a role, but there was something more going on. And I think especially for these PPA prices, the most important factor was that the wholesale forward curve was going up, and that was of course due to the higher gas prices and the ETS price. And so what you see now is that if you take the ratio of average PPA price to LCOE, you see that across European markets, that's somewhere between a factor 1.6 and 2.2. So you pay, as an off-taker, a lot more than, let's say, the underlying costs of the renewables. It's also partly due to increasing cannibalization, especially with solar in Spain and also renewables in the UK. So in the end, for industrial off-takers, the big culprit was just the higher electricity prices in the wholesale markets, and that volatility of the prices that were just impacting PPA. I think also industrials realized that these forward curves and that price volatility would most probably remain. You also saw in the PPA market a bit of shift to more market indexed price formulas, which basically reduced the risk to the off-taker of being, of basically anchoring that price on a high forward curve. So that partly eased the market a little bit. And then we saw as of 2023, again, that the PPA market was in full growth. So it was a bit of a slowdown. So probably we didn't reap the full potential growth of the market. I think industrials realize that they probably will have to pay more for PPA price than what they did before 2022. That being said, there's a lot that industrials can do, to change a bit their sourcing approach on PPAs. I think one is indeed looking at ways to maximize their electricity demand flexibility, and it can be with current assets, but that can also surely be with electrifying part of their processes and for instance, steam production. There's actually for one of my clients, we did an analysis where we basically modeled an electrified steam production system. Steam, just to give a sense, high pressure steam for about 15 to 30 tons per hour, so a pretty significant scale. And what we didn't model an e-boiler. You see some good cases across Europe with e-boilers, but what we did was take basically a thermal energy storage system. And that system was sized around 500 megawatt hours, so again, pretty large. Based on an electrified charging system. And then that system was coupled with a steam turbine. So basically what we could do with that system is decouple the timing of charging, what we do when electricity prices are obviously low, versus then decharging depending on indeed when you have steam needs or you want to generate electricity locally when you see that market prices are high. And actually, in this kind of with that system, we of course optimize that, take into account expectations of forward prices and of course day ahead prices and the volatility and the related renewables generation. And actually, we saw we could get to a system cost that was lower than basically an e-boiler, but also lower than even natural gas boiler combined with then sourcing grid power at at peak prices. So I think there are absolutely opportunities for industrials to put these systems on their sites to be able to valorize much more that market price volatility. And I think a second way for industrials to tap into that is make sure they can narrow that gap between PPA price and the LCOE, and that I mentioned that can be factor 2. One way to do that is in your PPA design, go to much more longer term offtake. So, go to 20 years instead of 10 or 15. Also agree that you take it as produced. So basically, following the generation profile of the renewable assets. Another way to do it is to take equity stakes. And that's also a trend that we see is especially where large industrial offtakers will get more directly involved because they recognize that, first of all, their electricity sourcing is of strategic nature. And also because they just want to get to more favorable economics and risk trade-off. And I think the best example in Europe, we have many, is BASF, and we set up a separate entity on renewables, and which is taking direct stakes. And so they took a stake in a field in Germany of 1.6 gigawatts. Same in the Netherlands, they took half a stake of a 1.4 gigawatts project. So this, I think, is good examples of how you can get organized as large industrials.
Okay, so that's our kind of snapshot of renewables, electrification. Nuclear, not an option everywhere, clearly, but we have seen from Decarb's perspective more a kind of a slowly increasing interest in what SMR potential might become. But again, what are you seeing and hearing?
Yeah.
And what do you think the reality will be maybe in 5 years' time?
Yeah, well, I think the discussion on nuclear is interesting, right? Because at the start of the decade, I think there was still a big taboo on the role of nuclear in the transition. And I also have to recognize that in a way, nuclear is declining. You have a very aging fleet, especially in Europe. So you see that number of reactors is going down, the share of nuclear is going down. And even what we saw as a response to the crisis, yes, some reactors are now prolonged, but it's not gonna it's not gonna change the overall trend. I think what were two important developments was, first of all, the fact that we saw on COP 2028 that there was a coalition, of I think it was more than 20 countries, more than 100 companies that actually, had a declaration where they stated that nuclear energy needs to be tripled by 2050 in order to be able to reach the climate goals. And you see, especially for instance, big renewable off-takers like big tech is now also fully endorsing nuclear. You've had the announcement from Microsoft. Okay, it's in the US, but where they are working with Constellation Energy to basically restart a nuclear unit in Pennsylvania. There's also Amazon that announced that they want to basically co-locate almost a 1 gigawatt data center close to an existing 2.5 gigawatt nuclear plant in Pennsylvania. So it's very visible reversal, I would say. I think also these small modular reactors, I think there as well, we've seen quite a lot of announcements. I think for the moment, it's more than 22 gigawatts of SMRs being announced. We've had the first SMR actually that came online in China, I think last year, 200 megawatt units. And again, it's big tech that's taking the lead. Amazon has a roadmap to build 5 gigawatts of SMRs. Google has development agreement to build a 500 megawatt reactor. But also, for instance, Dow as an industrial has a project in development with X Energy around 320 megawatt electric. So there's definitely movement. I think SMRs could play a role, probably only after 2030, and I see it only playing a role where there's really a large premium on expanding grid access or where you have security of supply concerns.
All right. So next on our hit list for a kind of mid-decade review is biomethane. So talk to me about this. Like what is it that you have seen in in progressing this?
Well, I think first of all, I think in Europe there was of course already an existing biogas, especially biogas market. So smaller installations, digesters, that were already built in the previous decade. Typically, in the context of building cogeneration units, was strongly incentivized in a lot of countries. So there is a bit of an established install base. Of course, that's biogas, so there's still a significant amount of CO2 in biogas. So of course, you still need to have purification units to be able to make biomethane that you can inject in the gas grid. But there you've seen, I think, a good evolution. I think in 22 in Europe we already are at 4 billion cubic meters of biomethane supply. If you would convert all the biogas units in Europe today, you would already have 19 billion cubic meters. So it's just an existing market. I think what was really important was to see, again, in response to the energy crisis, what's the beauty about biomethane is, of course, that it's a drop-in fuel, right? So it's exactly the same molecule as natural gas. So you can use it in existing infrastructure. In that sense, the conversion costs is low, but it also means that there's a lot of competing applications and demands. So you see in the building sector, there's an expectation that you won't be able to electrify everything. So there's going to be a role for hybrid heat pumps in buildings that still rely partly on natural gas, to cover peak demands. You see more and more mandates coming for blending biomethane in grids. For instance, in the Netherlands, there's a target to reach 20% by 2030. So that's going to drive a lot of demand for biomethane. Also in road transport, biomethane has its role because of all this competing demands. There's a huge upward price pressure. And it's also in a way crowding out partly industrial off-takers from this market. So we think today biomethane plants can probably produce at around 60 to 80 euros per megawatt hour. What you see is that actually market prices are more in the range of 100 to 120. So again, you see there a big wedge, and that's purely because of the supply-demand dynamics today. So given those competing demands on biomethane, my advice for industrial off-takers is to consider two things. So first of all, I think you have to consider how you want to use that biomethane, not just short-term, but mid-term as well. I think in the interim, it's fine if you want to use biomethane as a fuel. Will be at I explained, a pretty high price. But I think ideally for the midterm, you also identified use of biomethane as a feedstock in your production process, for which you ultimately can also drive price premium for your products. I think that is critical. And then second, don't rely on the spot market for biomethane, given not just that competing demand, but also some of the still regulatory changes that we expect. So there, I would recommend, if you're serious about biomethane, is to take a much more strategic, structural approach. See where you can engage with biomethane developers into more long-term biomethane purchase agreements. There's some examples of that, with in Engie, where we signed a 400 gigawatt hours annual deal with BASF, or 300 gigawatt hours with Arkema. So it's really important that you try to engage in a conversation with developers for larger scale offtake. It's the only way where you can, in a way, secure those volumes at more reasonable prices.
Hydrogen has had this swerve of a journey, I feel, in the last couple of years. So, perspective from you on this? I mean, the last thing I'll say before I push back to you is, I feel like even in 2021, this was a more hopeful technology for a lot of our industrials. There was a lot of interest then about how quickly they might be able to get a real live green hydrogen solution up and running. And now I would characterize it as, yeah, it's a technology that seems to have it's been pushed onto the back burner. What's your sense of it?
Yeah, no, it's a bit of a classical illustration of the hype cycle, right? Especially on green hydrogen. At the start of the decade, there was a consensus view that we would reach green hydrogen production at the cost of maximum €3 per kilogram. And the idea was that this would have been driven, first of all, by the cost declines in renewables that we discussed, but then also because system cost reductions, primarily because of an experience curve on electrolyzers. And so that was the hypothesis at the beginning of the decade. By the way, a hypothesis that drove a lot of groupthink. But then what we saw then, the economics did not play out as was expected. First of all, like I mentioned, on renewables, there was only not the LCOE increasing, but more importantly, the fact that renewable prices and PPA prices were a lot higher than what they were at the beginning of the decade. So that's one reason. But it's more than that. I think what we also saw is that what we believed would be the capacity factor of an electrolyzer were in reality much lower than what we believed, and that's very simple. It's because whenever you have high high wholesale prices in the electricity market, you will see that renewables will divert to serving that and will not be available to run electrolyzers. And so it's very hard in the current market to reach the required capacity factors in Europe, especially for on-site. And then next to that, for sure, there's also the electrolyzer costs that didn't scale down as quickly as expected. And I think we're now at an electrolyzer capex of at least twice as high as what we believed. I think right now we're more at a consensus of €5 to €8 per kilogram by 2030 for production in Europe. And if you look at the recent auction from the European Hydrogen Bank, you saw levelized costs ranging from 6 in Spain, which sounds good, mostly based on solar, of course, to 13 in France. And just to give you a sense, some of the more industrialized countries like the Netherlands was at 10, Germany was at 12. So we're still very far off from a number that can work.
And prediction for then 2030?
First of all, if I think of making green hydrogen work in Europe, I think there needs to be a debate around where we want to prioritize some of the regulatory action and where you want to actually also prioritize renewables. I think, first of all, what I think is important is that today, if you look at the use of electrolyzers, what we could do is find a mechanism by which these electrolyzers can have more direct access to renewables. And so just like I mentioned before on industrial off-takers, the same applies to electrolyzers. And make sure that you can close that gap between the PPA price paid and the LCOE. I think there's also a role to look at how can we better embed electrolyzers in the network to increase capacity factor. For instance, what works well is that you, for instance, try to combine wind and solar. And so, what can you do as a regulator to make sure that permitting or that type of deployment can be facilitated? I think looking at maybe in the interim, embracing more blue hydrogen as a kind of a bridging solution, you could say. And I think that realization is there because you see a lot of individual member states already recognizing potential role of the blue hydrogen in the transition and including it in their hydrogen vision and strategies. I think also now the EU is opening to that in the decarbonized gases and hydrogen package. They've now launched actually a new definition of low carbon hydrogen, where they say, okay, as long as you achieve a minimum of 70% life cycle emission reductions versus fossil-based hydrogen, it qualifies as low carbon hydrogen. So I think that's the first opening of the EU to embracing the potential role of blue hydrogen. And of course, if you look at UK is an absolute front runner in that respect. They already fully embraced blue hydrogen as part of the strategy. There today you have more than 5 million tons of blue hydrogen projects announced. So I think you'll see the same trend in some of the mainland European countries.
Okay, well, blue hydrogen then leads us into the last of the kind of key technologies, carbon capture. Arguably, perhaps the one of all of these where we might actually be where we thought we'd be by this point, but I don't know what whether you'd agree with that.
Yeah, on carbon capture, of course, has a history primarily in natural gas processing, and when you see the application of the captured CO2, was mostly directed towards enhanced oil recovery. So it's really something that came from the oil and gas sector. And again, because of those historical reasons, especially the beginning of the decade, was not fully endorsed by, say, the broader climate landscape. But again, we saw that some individual countries, I think in Europe, took the lead into recognizing carbon capture as a solution. Taking, for instance, of the Netherlands, and that also included as part of their renewed incentive schemes. So I think they already awarded more than 3 billion to carbon capture projects. You also see, for instance, Germany that was very long opposed to carbon capture, where essentially even the Green Party removed its opposition and released in the end, Germany released the CCUS roadmap, which is focused on steel, cement, petrochemicals. Same with France. They now have a roadmap that outlines 4 to 8 million tons of carbon capture by 2030. So you see a lot of renewed momentum around carbon capture. Eventually also translated into EU level policy support with the industrial carbon management strategy that sets a target of 50 million tons of CO2 capture by 2030. There was a Net Zero Industry Act that also should help on accelerating permitting and enhancing storage sites availability, etc. So you see a lot of change. And what was especially striking is if you look at the awards of the EU Innovation Fund, is that actually half of the 4 billion allocated, so 2 billion actually was allocated to carbon capture projects. My take on it for carbon capture is that first of all, you will see it will be primarily the oil and gas sector that will be the major investor and orchestrator of these projects, and because it's close to their historical competencies on geology and operating such pipelines and storage sites. So they will be the driving force behind it. And we'll see it in very specific sectors. So yes, in cement, and that's also the sector where we saw a lot of activity under the innovation fund. Why cement? Because yeah, it's pretty pure process emissions. You see it around indeed blue hydrogen, ammonia. Power sector, probably not that much. So for me, overall, it remains a little bit of a niche. For some sectors it will work, but it's definitely not a solution that applies to a broad set of industrial players.
For some sectors, but then also for some geographic locations. That's the other kind of.
Yeah, absolutely. Yeah. So proximity to infrastructure is key. Yeah, no, absolutely. So that's why again these incentives to build infrastructure are critical, and that's also where indeed the development of a blue hydrogen sector can ultimately also facilitate carbon capture in other sectors.
So that's the kind of the state of play and what you're seeing materializing in the next half of the decade. What about the kind of regional realities of EU? Like, where do you see strengths of the EU? And I guess no conversation right now of where we stand this decade would be complete without some reference to the US. And
Yeah.
let's not get into predictions of what will happen with the IRA. But yeah, what do you see as the kind of the regional wins and challenges for Europe?
Yeah, so I think honestly, I think the debate was a little bit too much focused on indeed the IRA and the response to the IRA, and how for instance Europe stacks up versus IRA in terms of like globally available subsidies, etc. For sure, that difference, right? I mean, the IRA has a certain appeal because there's a certain simplicity to the incentive structure, which is very different from the mechanisms in Europe. It's also very different because it applies a lot of local content rules. So in that sense, it was seen as a disruption to the global level playing field. So I get all of those concerns, but at the end of the day, my point of view is that subsidies should be an instrument to pave the way to developing infrastructure or growing market, growing a market to scale, where then it can function in an efficient way. But throwing subsidies at in essence, structural cost differences between regions is not a good idea, and is simply value destructive. And so we should still always look from the core reality, which is what's our competitive playing field, what are our strengths in the EU, and what are the structural cost differences.
I know we had sort of talked about before recording this that we could use steel to sort of look at the issue of end-to-end economics and how to manage transition in different sectors in a way that is really makes sense both in terms of spend, profit, progress. So having with steel in mind, what do you see as the sort of the way that as a sector it is or can manage the transition moving forward? And I mean, to be honest, I think probably this will stand for most sectors, right? So what do you see?
No. So globally, I think the sector will only start to move when you see that it's it's downstream sector. So basically, their off takers are show willingness to buy lower emission products, and I think that's again, it's not a single subsidy that will overcome that reality. So the key question indeed is how that willingness to pay and the so-called green premium will evolve. I think today super hard to make any market-wide statement on that. It remains very ad hoc, these considerations. I think particularly for steel, you'll see it, of course, in steel applications where you have a high impact on the overall emission of the product, but where you see that the value density of steel in that end product is low. So you can think indeed of automotive, wind turbines, etc., electrical steel applications. So that's where we'll see it emerging, simply because of the economics downstream. And indeed you see, I think BNEF tracks low emission steel offtake agreements. You see today 40% of these offtake agreements are effectively in automotive, so they're really leading the charge. But in my conversations with steel off-takers, I've noticed that even, for instance, within automotive, that premium is estimated at around 200 to 400 euros per car. There's a lot of OEMs that simply do not want to pay that. So I think it's very much an individual question. So the first thing is that if you want to explore that market, it will, as a steelmaker, require you to reach out, go out, talk to your key customers, and basically get into individual longer term agreements. Otherwise, that shift will not happen. Because if you look at the overall market development of green steel, we really have to overcome still quite a bit of hurdles. And there's, first of all, even the simple definition of what green steel means. The second key area is think how we work with product emission allocation rules. So today, what you see is that a lot of steelmaker initiatives on low emission products are based on mass balance approaches. And so in a mass balance approach, what you can do is, we have a certain site where you invest in emission reduction. And what you can basically do is allocate all of that emission reduction to particular steel volumes. So you can enable off-takers of these products to use these credits to reduce their Scope 3 emissions. But I must say this is not something that's widely endorsed and adopted and approved by other players in the sectors. And a lot of steelmakers basically want to set the bar higher, and they want to get more to a real embodied carbon approach, where you basically verify based on the actual production how much emissions went into the production, that you can certify basically that product. Reality is that today you don't have standards or measurement verification methods that enable that. And so that still needs to develop before you can go with such an embodied emission approach. So, on these two fronts, as long as you don't drive more convergence, you'll see that action by steelmakers will really depend on the individual agreements that they can make with their customers. There's clearly an example that it's possible, and but you really, as a steelmaker, you have to go out and make it happen. So that is one element. The second, I think, is that as steelmaker, you need to be, in a way, creative and look at all the options, how you can navigate that transition. Because clearly that market will not shift overnight, will be a very long, gradual process. Probably will take us till 2040 before we really have something like a unified green steel market. So I think right now the question is, okay, how do you navigate that? And there, I think there's some opportunities for certain European based steelmakers to find technical solutions that enable you to better track this transition. And one example, but there are probably more, is, for instance, using synthetic methane or e-methane in these DRI installations. Why? Because in the end, the DRI installations today, it's proven to run on natural gas, so that's no problem at all. You don't need to convert those installations. And basically with e-methane, you can again just use it as a drop-in fuel. So it means that what you can do is find a kind of production approach where you only input as much e-methane as you need to reach a target emission output in your steel. So that means that if you have a range of customers, some customers maybe expect you to achieve a 40% emission reduction versus your benchmark. All the clients are simply not willing to pay for any emission reduction. Is that in your production scheduling, you can decide, how much e-methane you use to reach that target emission outputs. And that allows you basically as a steelmaker to better align that willingness to pay of your customers to your production inputs. So you avoid really that big bang change. In itself, of course, the e-methane is more expensive even than green hydrogen. But end to end, if you do it only for these customers that are willing to pay for it, it's a scheme that can actually work, especially in this transition period. So it's just one example. Of course, I cannot go into all of the specifics of the costs, etc. But I think it's this from the economic and technical standpoint. We have to look beyond, just the operational reality and really connect that operational and commercial reality and find more novel ways to navigate it.
Yeah, it's the it's the bigger picture of, as you were talking about on renewables, like what does this mean for negotiating the right renewables? What does this mean for bridging using mass balance or other tools? It's more nuanced, I suppose, a more nuanced stage that we're at for industrial decarb, where it's
Correct. And I think that there's more that we can do on the demand side of these green materials. So I think again, don't want to always point to regulation, but I think when it comes first to public procurement initiatives, there's no reason why today you're not putting the bar a bit higher, and you try to maybe include a certain price premium in trying to develop these markets. I think it's the most effective way. It's more effective, I think, than subsidies on the supply side. So things like the Green Public Procurement Initiative in the EU, or the Industrial Deep Decarbonisation Initiative. These are initiatives that I think can be accelerated, and where we can also have more binding agreements and targets against. It's really these areas and applications that we need to start to shape the market and put the right incentives behind to really give that demand signal to steel makers to start to make the transition.
Okay, well, moving then to kind of the wrap up. What do you think, if you and I were recording in 2030, what do you predict is really going to be the kind of the three also drivers of the next 5 years then?
Well, like I said before, so I think we're now much more grounded into economic reality, and I think it's a positive thing. And so we've been riding this hype cycle, and I think we're now really in the middle of the transformation. It's a sign that we now have a much better idea how we can overcome the constraints of the transition. So I think we're now on a much more realistic pathway to 2030. We're in a much more realistic approach, with developers, with whole ecosystems, with regulators and incentive schemes behind to try to make it work. And I think we'll still see a lot of course adaptations in coming years that will facilitate more that move towards 2030. And again, I think there was a lot of despair, especially around some of the things I described on the energy crisis and the pandemic. But if you think back, in Europe in the 70s, we're exactly in a similar situation, where I think inflation also was persistent double digits. We had interest rates of 10%. We are in actual recession. GDP fell with 3%. So, and at that time, Europe was not even a single economic union. So I think we've proven it in the past that we're adaptable, that you can find ways to make it work, and I'm absolutely confident that despite the despair that some have, we'll find ways to make it work also this time. So that is my first prediction. The second one, I think, is if you look at Europe, I think it's really also the market where the transition to green materials will really happen, and why that is, I think, because first of all, there's the proximity to all of the offtake markets and the clients that will take these materials. So that's just a huge asset, that will continue to be a basis for innovation, and also a basis to just let the market mechanisms work. And I think we should, again, like I mentioned before, we should just recognize what the relative strengths are of Europe and just double down on those. Yes, it's very complicated landscape, and some of that they will harmonize and simplify. But I think it's much more thoughtful and enduring, and in a way covers almost all aspects of the transition that we'll have to go through. And I think the Commission is also now showing that they will take a much more balanced approach to driving the transition versus make sure that we can remain competitiveness for industrials in Europe. So I think also on the regulatory side, there's much more sense of reality. And for me, it's just it shows that probably in Europe we have the best recipe to really develop that integrated market mechanism that we need to shift to these green material markets. And I think compared to other regions, I think our policy direction or our support schemes will prove to be much more resilient. And so in that sense, I think that Europe has the best chances to drive this development going further.
Whatever we predict, there will be brand new elements, brand new technology, strategies, ideas that will come into play by then, just as there have been in the last 5 years. And of course, really interesting to see how the US market unfolds, and less in terms of how it affects Europe, so much as what we might take from it, what we might learn from that. I mean, the IRA was something that felt immensely threatening when it came out, but has actually driven quite a lot of interesting policy and action and activity in Europe as a result.
Correct.
So
Correct.
it's interesting to see how that plays out as well. But thank you, Ben. Really fascinating, both to look back, but also to think about, okay, well, what does that mean for the reality of the next 5 years? So thank you for taking us through those key technologies, but also that overview.
Thank you so much.
At Jano Media, we recognise that great content has the power to create impactful and positive change for lives and society. Whether that's video, live streams, photography or podcasts, partnering with us will enable you to harness the power of content to engage, inform and inspire. Reach out to us today.